Welcome from New York. You'd think that the people behind me working in the financial district would have had a banner year. Stocks are up and bonds are up. But in fact, for many of them, it's been an annus horribilis. Active fund managers who take people's money and try to beat the market with it have failed to do so like never before. Goldman Sachs reckons about 15% only managed to beat their benchmark. Some estimates think it could be even lower than that.
The most recent data I've seen have been from Morningstar, and I believe their report says that roughly 85% of all active managers in 2014 have underperformed their benchmarks. In a typical year, you might expect 55% or so to underperform, so 85 is a lot.
But it gets worse. There's also evidence that good performance doesn't persist. Do well one year and there's no reason to expect that you'll do well the next. In fact, quite the reverse. Small wonder then that people are deciding that whenever you do beat the market, it's not about skill, it's just luck.
And what we find, no matter how you slice those data, you can say upper half, quartile, thirds, however you do it, the chance of identifying a manager who's going to be above average 4 years in a row is roughly the same as the chance of flipping a coin and getting 4 heads in a row, which is another way of saying there may be persistence in manager skill, but it's very difficult to detect in the data.
Only 53% of individual investors believe that alpha is primarily based on skill versus luck. Now, we couldn't, of course, use the word alpha. We had to use the word outperformance and explain the heck out of the definition because individual investors don't know what alpha is, nor should they. So surely investment professionals must be far more optimistic about their own abilities. Unfortunately, they are not. Only 42% of investment professionals believe that alpha is primarily based on skill versus luck.
Now, it shouldn't be a surprise that such dreadful performance figures are now beginning to hurt sales. As you can see from this data from Morningstar, what was already a steady flow or a trickle out of active funds and into passive funds has this year turned into a veritable flood. And that's in particular driven by the phenomenon of exchange-traded funds, or ETFs, which are directly tradable on an exchange and, as far as the ultimate investor is concerned, much cheaper than normal mutual funds. Further, the very theory seems now to go against active managers. On average, it's pure arithmetic. The average fund manager can only hope to match the index. If you then add on fees, that will reduce the return and mean that the average fund manager will lose to the index. The logic is unbeatable.
Most individual investors would be better off moving to passive management. And that's because the fees are considerably lower and because the individual investors tend to only look at one signal when they choose an active manager, and that is past performance. And so they're overweighting a very noisy signal. They're chasing performance. They're ignoring fees, which are extremely predictable. And it serves them poorly.
It begins to look as though active managers are doomed. But there's a problem here. We need active managers. Passive managers are never going to help put an accurate price on stocks. They're not going to help guide capital to the right places. And indeed, there is now a fight back afoot by active managers. This research by Yale University is fascinating. It found that a big part of the problem is that active managers just haven't been active enough. If you sort out mutual funds according to their active share, by how much they vary from the index, the ones with the highest active share are the most different from the index, you can see that the more active you are, the more likely you are to beat the index. Not only that, if you compare before costs and after costs performance, you can see that the average mutual fund actually beats their index before costs. So those are the two critical things. They have to be active and they need to cut costs. Let's find out how they're doing it.
In our database, we have all the active equity mutual funds, both US and international, and we see hundreds of different ways of making money, and they can be successful if it's a narrowly defined strategy consistently pursued with high conviction positions.
There are new ideas that help managers go below outcomes and look at individual skills. And what we found now, working with over 100 portfolios around the globe, is once managers have this rigorous and granular feedback, they're able to improve deliberately. In fact, one of our studies shows that across 100 funds, the average performance before working in a deliberate improvement mode was 98 basis points below their benchmark. And in just 4 years, the average is 152 above the benchmark. That's a 250 basis point swing in just 4 years, and it was done step by step by these managers learning how to improve deliberately.
So all is not lost for active fund managers. With any luck for them, next year will not be quite as bad as 2014. But be under no illusion. If active managers are going to persuade people to give them money in future, they're going to have to prove that they're being truly active and committed, and they're going to have to cut their fees.